All right, Courtney, we got to ask you. I know the S&P and the Nasdaq finished at record highs yesterday, but are there market implications with this shutdown in either the equity market or the bond market?
Well, first of all, I think as we all know, the one thing that the markets do not like is uncertainty. Now, that being said, generally speaking, what you'll see is a rally in the bond market, right? And I think we're seeing a little bit of that on the short end of the curve, and the long end of the curve is somewhat down a little bit. And we're going to see equities potentially wobble. Now, in reality, a short-term shutdown, we don't expect to see significant impact to the bond or the stock market. But should the actual shutdown persist, volatility will rise. Now we're on the lower end of the volatility end of the spectrum right now. I think we're around 16 or so. If we think about 52-week highs, we were somewhere around 60, lows at about 13. So we're still kind of in lower vol territory, if you will. But should this shutdown persist, should we not get the data that the Fed needs, the Fed remains data dependent and always will, should we not get that, markets will start to see a bit of an impact because it's going to cause people to become shaky. Institutions are going to kind of have a flight to safety, and that will start to be concerning, especially as we look at the labor market. Should we see persistence again with furloughs? I mean, those furloughs becoming permanent, that's a big deal. Okay. That's a big deal for the market.
So you're saying data is very important to the market. So I want to point out, we're going to show everybody, if the shutdown continues, which it looks like it will, because this is the Senate's off for a holiday today, we're not going to get the jobs report on Friday. Potentially, we're not going to get CPI on the 15th of October, and maybe not PPI on the 16th of October. So when does this become an acute problem for the market in your mind? We got a read on the job market from ADP yesterday. It wasn't good. I don't think a lot of people think the September jobs report is going to be stellar. So we have a sense that the labor market's weaker. But these inflation reports, does that become a problem for the market because the Fed has less data? Or is it just a problem for the market just because the market doesn't have that data?
Well, the market will have that data, right? But it'll be via private reports. I mean, ADP, that's a private report when we think about that.
Well, I meant PPI and CPI, though. Like, does that become a problem for the market to not have a clear read on inflation, or is it a problem because the Fed doesn't have that data?
I think it's more of a problem because the Fed doesn't have that data. And so the question becomes, what will the Fed do? Will they become more dovish and ultimately say, hey, we need to cut more? Or will they actually pause because they are data dependent and they will wait on that data in order to inform the rate cuts for the balance of the year? I mean, I think we're expecting around 3 rate cuts through the balance of the year. Should they not get that, does that put those rate cuts on hold and ultimately then the market begin to recalibrate based upon its own data, which, again, we saw earlier in the year where, again, long end of the curve began to spike from a yields perspective. So it is more, from my perspective, that the Fed not having that information in order to inform rate cuts that will ultimately impact the markets.
All right. What do you make of the action in the market we've seen this week? Healthcare is the leading sector, followed by utilities. Those are generally defensive sectors. At the same time, we see tech hitting a new time high and the market's hitting a new time high. That doesn't seem like that's a scenario that happens often, but please, I mean, educate me. Do you see that very often? Defensive sectors moving higher, with tech moving higher and the market moving higher all at the same time?
Well, I think there's an interesting storm right now in the markets overall, right? So you're seeing that flight to quality, flight to safety, hence the bond yields kind of coming in a bit, where you're seeing, again, that defensive tilt in the market with healthcare, with utilities. But what you're seeing on the tech side is primarily driven by those AI names, more of an investment in technology, in cyber. What you're seeing is companies becoming more efficient with fewer people, ultimately, and allowing this tech rally to help them to fuel growth. And so I think that's why you're seeing this somewhat bifurcated impact in the market today. And we're seeing it as well at TIAA and our investment management arm in Nuveen. We're seeing that flight to quality. We're seeing a more persistent view by our participants in the market that they want security, that they want retirement security. And what they're leaning towards is more conservative, if you will, and balanced portfolios that ensure that they have those guaranteed paychecks at the end of the day, which is what people want.
You know, speaking of retirement, I want to talk about your wheelhouse very quickly. You lead TIAA's retirement business, about $955 billion in assets. You say people are moving towards target funds, looking for guaranteed income. We've been talking a lot about private investments in 401ks and for retirement accounts, but you're saying people are looking for more security, not more risk.
Well, it's interesting. Private markets can pose more risk, but what we guide our participants to is one, save. First and foremost, save. Second, make sure you're saving in a way that you have a diversified asset allocation that's balanced against your respective risk profile. So, having bonds, having stocks, having a guaranteed asset class as a part of that target date fund is critically important. We do a survey at TIAA, and 95% of people, and I'm sure you're probably included, would want to have guaranteed income in addition to Social Security. We're also seeing that the plan sponsors or the employers ultimately are saying, we want our employees, our associates, to have guaranteed income as an option as a part of their diversified portfolio. So as you're seeing this flight to quality, we're seeing that flight to quality as well via our core annuity product in TIA Traditional. People are
Okay.
saying we want a diversified portfolio, but we want some protection during accumulation, and we want to have the option for guaranteed lifetime income on the back end. So that trend, the same broader trend that you're seeing in the market, you're also seeing when it comes to retail, when it comes to participants saving for retirement.